Well, another Fed week is upon us. The Federal Open Market Committee is meeting on Tuesday and Wednesday of this week, and they are widely expected to deliver another interest rate cut of 25 basis points when they come out of their meeting on Wednesday. We received the inflation report and the CPI last Friday. This came a week later than scheduled because of the government shutdown. But this inflation, it did show that the numbers on a month-over-month basis came in a little softer than expected. And it really gave the Fed the green light that they needed to proceed with this rate cut this week. Now, the decision probably won't be as easy in the upcoming meetings. The next one is in mid-December. And the reason for that is that this inflation data last week also showed us that inflation remains a little bit of an issue. And I think that opinions vary within the Fed, but we are looking at inflation data that is still around 3%. There's a number of ways you can measure it, but most of the data is still at or above 3% on a year-over-year basis, and that is compared to the Fed's target of 2%. Now, this is going to be a really interesting week, not just because of the Fed meeting, but because we are in the middle of earnings season. So far, the earnings season is going very well. We're looking at over 85% of companies that so far have reported, and they've announced earnings that came in better than expectations. At the same time, we're seeing about 82% of companies that have reported sales that came in ahead of expectations. I think that's really important because, sure, companies can change their operations, they can cut costs, they can manage their earnings numbers to get over the hurdle and the estimates that analysts have on the street. But sales tell us that their operations are still pretty good and that they're still able to sell in this tricky environment. So we are happy with what we see so far, but this is a big week for earnings. About 50% of the S&P 500 is reporting earnings this week. And among that 50%, there's really five big ones. There's Microsoft, Alphabet, Meta, Amazon, and Apple that report on Wednesday and Thursday of this week. That group collectively accounts for about 25% of the S&P 500. So in a way, this is a make or break moment for them and for the broader S&P 500, just because we know that so much has been riding on the performance of a handful of mega cap tech stocks that are associated with artificial intelligence. So what we've seen is in recent quarters is a lot of these companies have been investing quite heavily in the build out of artificial intelligence. We've actually seen the numbers move into the hundreds of billions in terms of what they're spending on an annual basis. In most cases, what they're spending actually eclipses the revenues that they're receiving as part of what they're doing in artificial intelligence. So they're really putting a lot of investment in here. For the time being, investors are giving them the benefit of the doubt that they will see the results from all of this investment. So time will tell. But this is really critical because we are looking at numbers, at stocks that have been bid up. And so what we are going to be on the lookout for, and I think what Wall Street's going to be on the lookout for, is what they say with respect to the future investment in artificial intelligence, and are they seeing some benefit yet, or when are they going to start seeing the benefit? Eventually, investors are going to demand it. The question is when. And so we are really interested in this to see what they report. I will say that in terms of their contribution to earnings growth and the earnings growth that they're seeing on a year-over-year basis, these numbers have been trending down. It was just a couple years ago, on an annual basis, they were seeing about 50% earnings growth year over year. And just last quarter, it was around mid-20s%. It's still expected to be pretty high this quarter, about 17% on a year-over-year basis. But that number is trending down, and in large part, I'd say for a couple of reasons. One, because the comps are so hard on a year-over-year basis. But another reason driving this move lower in terms of earnings growth is because they are investing so heavily. So I do want to point that out. There's a lot riding on this earnings season, especially for them. But if we just take a step back, I think it's so important to acknowledge this. And it's one of the reasons that we are diversified across our portfolios. You can have conviction and confidence and play this artificial intelligence theme, but I think it's important to be mindful of your exposure And we have a number of these names across our portfolios, but we are still diversified. And I think that's the name of the game here. We are diversified across our portfolios. We are looking at earnings that is moving lower on a year-over-year basis for these handful of stocks. We are looking at a bar that is increasingly high because of the capital investment that's going into the artificial intelligence theme. And we're mindful that there's a lot of good companies out there that aren't affiliated with tech, and they will be the eventual winners or beneficiaries of artificial intelligence if it does move forward. So we are diversified across our portfolios. We remind our clients that you can play these themes, but don't lose sight of the fact that diversification really is the only free lunch when it comes to investing. And so that's what we're doing here. But I'll leave it there for right now. I'll look forward to catching up with you next week. As always, if you have any questions, please don't hesitate to reach out to your financial advisor.